In this video, we're going to look at tax planning with regard to inventory, because the choice of inventory valuation has tax implications. And on the exam, you need to know FIFO versus LIFO and the advantages and disadvantages of each for tax purposes. For example, if prices are rising, LIFO results in a higher cost of goods sold. Higher cost of goods sold means lower gross profit. Lower gross profit means lower taxable income. Compared to FIFO, if prices are rising, LIFO will result in a lower taxable income. So for planning purposes, using LIFO when prices are rising would result in lower taxable income. And that's what you want to show, lower taxable income. The problem is if LIFO is used for income tax purposes, LIFO must also be used for financial reporting purposes. That's known as the LIFO Conformity Rule. And the exam could ask you about this rule. If a company chooses LIFO for tax purposes because they know that would help show lower taxable income, they would have to use LIFO on the financial statements. And that would also result in lower financial reporting income. And the corporation wants to show higher financial reporting income. So that's why LIFO is often not used for tax purposes, because the corporation knows that they would have to also use it for financial reporting. And that brings us to FIFO, which is more straightforward because it aligns with the actual physical flow of goods, making FIFO an intuitive method for inventory management. When prices are rising, FIFO will typically result in higher taxable income because the older, cheaper inventory gets recorded as cost of goods sold, as the first in is the first out, and the first in is the older, cheaper items. Under FIFO, when prices are rising, cost of goods sold will have the lower cost items, leaving more for gross profit and ultimately taxable income. So FIFO can be beneficial for businesses seeking to show profitability to investors, but higher profits result in higher taxable income. And as a result, higher current tax liability using FIFO when prices are rising compared to LIFO. So the exam could ask you something like this. Which of the following is correct concerning LIFO compared to FIFO when prices are rising? Okay, what's correct concerning LIFO? A, current tax liability is higher, cost of goods sold is lower. So LIFO is the one where the more expensive items are transferred to cost of goods sold first. So if prices are rising, cost of goods sold will have the more recently purchased, more expensive items, which means cost of goods sold will be higher, not lower. So A is out. B says current tax liability and ending inventory would be higher under LIFO if prices were rising. No, because we just said that cost of goods sold will be higher under LIFO if prices are rising. And ending inventory and cost of goods sold are opposites. So if cost of goods sold is higher, ending inventory would be lower under LIFO if prices were rising. So B is out. C, current tax liability is lower, ending inventory is higher. No, we said ending inventory is going to be lower because cost of goods sold is going to be higher under LIFO if prices are rising. So it must be D, cost of goods sold is higher. We know that under LIFO if prices are rising. And that means if cost of goods sold is higher, taxable income is lower. And if taxable income is lower, then current tax liability is lower. So the answer is D. With LIFO, when prices are rising, the most recently acquired, typically more expensive items are considered sold first, leading to a higher cost of goods sold and thus a lower gross profit. Lower gross profit leads to lower taxable income. Lower taxable income leads to lower current tax liability. So be ready for a question just like this. Let's try this. What effect does the FIFO method have on a company's tax burden when prices are rising? All right, so first in, first out, when prices are rising means what goes to cost of goods sold? The older, cheaper items, which keeps cost of goods sold down, gross profit up. And if gross profit's up, taxable income is going to be up. And if taxable income's up, that's going to increase the tax burden. Which one says it best? A says reduces the tax burden. No. B increases the tax burden because of higher reported taxable income. Yeah, that's what it sounds like to me. C, no effect. No. D, reduces the tax burden. Letter B is correct. Under FIFO, the inventory assumed to be sold first is the oldest, which in a period of rising prices would typically have been purchased at a lower cost. And this would result in a lower cost of goods sold, higher gross profit, and therefore higher reported taxable income. Consequently, the tax burden would increase because taxes are based on taxable income. How about this? If a company expects the cost of its inventory to continue rising, which inventory method could help minimize current tax liabilities? So we just learned that if you want to minimize current tax liabilities in a period of rising prices, you use LIFO, because then the cost of goods sold will be so high that the gross profit and then the taxable income will be lower. So it's got to be B or D. Rule out A, rule out C. B says LIFO, as it will result in a higher cost of goods sold and lower taxable income. Yes, that looks good. D says LIFO for income tax purposes and FIFO for financial reporting purposes. We know that's not allowed. So the answer is B. If a company expects the cost of its inventory to continue rising, the inventory method that could help minimize tax liabilities is LIFO, because LIFO results in a higher cost of goods sold when prices are rising and therefore lower taxable income. Letter D is wrong. We know if you use LIFO for income tax, you have to use LIFO for financial reporting. You can't use LIFO for income tax and then FIFO for financial reporting. All right, which inventory method would typically yield a higher taxable income in times of decreasing prices? And if you think you know, leave me the answer in the comments section. And remember to like and subscribe because it helps the channel out a lot. And if you need more help with TCP or any other CPA exam, go to i75cpareview.com. Get yourself on I-75 with me, Darius Clark, where the right teacher makes all the difference.